Hi folks, welcome to a product review at Finominal. Today we're going to look at one of the largest hedge fund ETFs, namely DBI's Managed Futures Strategy ETF that trades under the ticker DBMF. Now, this ETF aims to replicate the performance of managed future hedge funds. These are also known as CTAs or trend following funds. And the strategy is effectively to exploit trends across asset classes via long and short positions. Now, the ETF has accumulated more $1 billion of asset under management, which makes it either the largest or second largest hedge fund ETF. Now, let's have a look in terms of what makes this product so successful. The first thing we're going to do is see what makes this product tick in terms of from a risk return perspective. And we're going to run a returns-based factor exposure analysis that shows us the factor betas over time. Now, what we see is effectively that the exposure to equities or the S&P 500 was effectively positive but minor since 2019. We can also see that the exposure to commodities was positive but minor. What's more interesting is that the exposure to the US dollar index was positive, negative, positive, just following trends. And similar, the exposure to bonds was positive and then consistently negative. Now that makes sense because bonds were in a bear market. So effectively this fund has been shorting bonds since, well, 2021. Now, this is a very simple way of trying to see what's the current exposures, and as trends change, we would expect this to change as well. And as next step, let's see how this strategy would have helped investors to diversify. And we're going to use our Diversification Booster tool for that. And the aim of such strategies is to offer uncorrelated returns to equities and bond markets. And that was indeed the case. So what we do see that over the last 5 years, the correlation to stocks was almost zero. Correlation to bonds was negative because it was shorting bonds. And we do also have variable favorable upside beta to the S&P 500 and downside beta to the S&P 500. Now, a quick way of seeing if a product is diversifying is looking at this chart, which simply shows you what would have happened to the Sharpe ratio of the S&P 500 if you would have added a 25% allocation to DBMF. And this shows that the Sharpe ratio would have increased from 0.67 to 0.82, which is great. Now, we can see on the left-hand side that the CAGR actually decreased versus just holding 100% equities, but that's kind of expected given that the S&P 500 largely has been a bull market over the last 5 years. Having said that, there is a significant reduction in drawdown, where the drawdown of the portfolio was really 27% versus 33% or 34% for the S&P 500. So stated differently, DBMF generated significant diversification benefits for an equities portfolio. Now that's great, but let's see how DBMF stacks up versus its peers. And we need to differentiate between its mutual fund peers and ETF peers. Now, we're first going to kick off with a bunch of mutual fund peers. And these are by firms as AQR and Virtus. Going to add a couple of more here. And finally, this product. So effectively, we're choosing these products simply because they have a longer track record. And most of the ETF peers of DBMF have a short track record. Now, DBMF often gets challenged that it might or has not replicated the performance of managed futures precisely. But actually what we see over here is exactly the opposite, that DBMF, and you can see that the blue line has exhibited the same trends as these mutual fund peers from large quantitative asset managers or hedge funds like AQR or Credit Suisse that do this in an Act 40 fund format. Now that's great. So effectively, DBMF does what it's expected to do. we can see the correlation is low of DBMF to some of these other funds, but we can also see that the correlation of the other funds are also on the lower side. Now, from a risk control perspective, we can see that the volatility of this product ranges significantly. So you can see DBMF is on the higher side from a volatility perspective, but also from a return perspective. Other products like the one from Credit Suisse or AQR, they do have low volatility because it gets managed more actively, but they also offer lower returns. From a Sharpe perspective, we see that DBMF has generated a Sharpe ratio of 0.71, which is slightly lower than that, for example, of AQR, but it's higher than those ones of the Credit Suisse and Altigra's funds. So that's great. And what's actually quite nice about DBMF, that it's only 85 basis points, that there is no minimum investment compared to the much more expensive mutual fund peers. Now, that's kind of good news, but let's have a look if we can get even better value by comparing DBMF versus its ETF peers. And so given that the performance of managed futures has been quite strong over the last couple of years, there's been more products. We're going to focus only on 3 other peers, which are a product from KFA Mount Lucas Simplify, and then one from the Wisdom Tree Group. Now, if we compare the performance of those 4 products, we do see that 3 of them, which is DBMF, KMLM, and CTA, approximately had similar performance over the last 2 years. We do see there was a significant drop by CTA in 2023. And we do see that that 4th product from Wisdom Tree is completely different. So whatever the strategy is, it's not the same thing what CTAs are doing. If we look at these products from a risk return perspective, we do see that DBMF is kind of like in the middle from a volatility perspective, versus some of the other products have a much higher volatility. And from a Sharpe perspective, now we should recognize it's only 2 years. DBMF was on the higher side compared to KMLM and the product from Wisdom Tree, but slightly lower than the one from Simplify. And here the fees are almost comparable, 0.85 versus ranging from 0.65 to 0.9. So that kind of wraps up our product review of DBMF. Now, we like this product a lot, simply because what this kind of represents is almost a passive strategy on managed futures. And we're big fans of managed futures simply because they diversify portfolios quite well. There's long periods of 0 returns, but that's just part of diversifying strategies. And that these have become available via ETFs at a low cost, like DBMF, compared to more expensive mutual fund peers, is great for everyday investors. Now, that concludes our product review of DBMF. Hope this was useful. Have a nice day.